Have you ever thought about investing in stocks but don't know where to start? Welcome to the fascinating world of investing, a realm where patience, knowledge, and strategy can lead to substantial wealth growth over time. Investing in stocks is a powerful way to build your financial portfolio and secure your financial future. It's about buying a piece of a company and becoming a partial owner, sharing in its successes and failures. However, like any venture, it comes with its fair share of risks. The stock market is a roller coaster ride of ups and downs. But remember, with higher risks often come higher rewards. It's important to understand these dynamics before diving in. Investing isn't a get-rich-quick scheme. It's a long-term commitment that requires consistent effort, understanding, and adjustment. But don't worry, with the right knowledge and guidance, navigating these financial waters can become second nature. Investing in stocks may seem daunting, but with the right knowledge, it can be a worthwhile venture. The first step in the journey of investing is setting up a brokerage account. Now you may ask, what is a brokerage account? Well, it's kind of like a bank account, but instead of holding money, it holds investments. It's your gateway to the stock market. But before you dive in, it's crucial to do your homework. Find a broker that suits your needs. Consider factors like fees, services, and platform user-friendliness. Once you've made your choice, you'll go through a registration process. This typically involves providing some personal information and agreeing to terms and conditions. Now comes the exciting part: funding your account. This is where you deposit money that you will use to buy stocks. You can transfer funds from your bank account or other sources. And there you have it. You've set up your brokerage account. Once you have a brokerage account, you're ready to start buying stocks. Before buying stocks, it's crucial to understand what stocks are and how they work. In the simplest terms, buying a stock means buying a piece of a company. This makes you a shareholder, giving you a claim on part of the company's assets and earnings. There are two main types of stocks: common and preferred. Common stockholders have the potential for profits and the risk of loss, while preferred stockholders have a higher claim on dividends and assets. Now, dividends are a portion of a company's profit paid out to shareholders. Not all companies do this, especially those that are still growing. Instead, they might reinvest these profits back into the business. Understanding these basics gives you a clearer picture of what you're getting into when you invest in stocks. You're not just buying a ticker symbol or a stock price, you're buying a piece of a business. Understanding the basics of stocks is key to making informed investment decisions. Investing in stocks should align with your financial goals and risk tolerance. Now, what does this mean? Well, your investment goals could be anything from saving for a new car to funding your retirement to building wealth for future generations. These goals determine what kind of investor you are and help shape your investment strategy. On the other hand, risk tolerance is all about how much risk you're comfortable with. Can you sleep at night knowing that your investments may fluctuate in value? Or do you prefer a more stable, less risky investment? Remember, higher potential returns often come with higher risk. Your goals and risk tolerance influence the stocks you choose to invest in. For instance, if you have a high risk tolerance and a long-term goal, you might invest in growth stocks. But if you're risk averse and have a short-term goal, you might prefer more stable, income-generating stocks. Your investment goals and risk tolerance should guide your stock selection. Now that you understand the basics, it's time to do some stock research. Just like a detective, you need to gather evidence before making your decision. This is where stock research comes into play. Researching stocks is like getting to know a person. You want to understand their history, their current situation, and their potential future. You need to look into their financial health by examining their balance sheets, income statements, and cash flow statements. These will give you an idea of the company's profitability and stability. Pay attention to factors like the company's earnings per share, its debt-to-equity ratio, and its dividend yield. These numbers can provide insight into the company's overall performance and growth potential. You can use resources like financial news websites, stock analysis tools, and investment forums to gather information. Remember, the more informed you are, the better decisions you can make. Research is a crucial step in the stock investing process. It's like a compass guiding you through the wilderness of the stock market. Diversification is a key strategy in investing. But what exactly is it? Simply put, Diversification is the practice of spreading your investments across different types of assets to reduce risk. Imagine you're at a buffet. Instead of piling your plate with just one dish, you sample a little bit of everything. That's diversification in a nutshell. Now, why is it so important? Well, the financial market can be unpredictable. If you invest all your money in one type of stock and it plummets, you could lose a significant portion of your investment. But if you have a diversified portfolio, with investments spread across various sectors and asset classes, you're less likely to lose all your money if one sector or asset class performs poorly. Remember, diversification isn't about making quick gains, it's about managing risk over the long term. So even if some investments don't perform as expected, others might do well, balancing out your overall returns. Diversification can help manage risk and increase potential returns. Investing in stocks doesn't end with buying. You need to monitor your investments. It's not about watching the stock market all day, every day. It's about keeping an eye on your portfolio, understanding the trends and making necessary adjustments. Why is monitoring so important? Because the stock market is dynamic. The value of stocks can rise or fall based on a myriad of factors, from economic indicators to a company's performance. Monitoring helps you stay updated with these changes. So, how do you monitor your stocks? There are various tools and platforms available that provide real-time data, analysis and alerts. These tools can help you track your stock's performance and compare it with your investment goals. Remember, it's not about reacting to every single market shift. It's about understanding the bigger picture, recognizing patterns, and making informed decisions. Regular monitoring allows you to make informed decisions about your portfolio. Investing in stocks can be a rewarding journey if done right. So, let's recap. We've walked through the steps of setting up a brokerage account, understanding the basics of stocks, and identifying your financial goals and risk tolerance. We've also delved into the importance of thorough stock research and the value of diversification in your portfolio. Remember, the key to successful investing is knowledge. Equip yourself with comprehensive information about the stocks you're interested in, and don't forget to constantly monitor your investments. Investing is not a gamble. It's a strategic game of patience and discipline. It's about understanding your financial goals, being comfortable with the level of risk you're taking, and making informed decisions based on solid research. So keep learning, stay focused, and remember, every great investor started as a beginner. For more investment advice, ensure to subscribe to this channel. You're one step away from becoming a more informed investor.